Hi. So, in my opinion, any fund management style in terms of philosophy should try and answer three key questions. How does the fund manager pick a stock? How do we construct the portfolio? And how and when we sell the stock? A lot of focus is given on the first question, which is about how do we pick the stock. But the other two are equally important, especially in a small and mid cap strategy. So let's come back to the first question first, which is how do we pick the stock? So that is where our framework comes in. So we call it good to great framework with a flywheel effect. It's actually inspired by the book called Good to Great, the same name, and it's written by the author called Jim Collins. So what the author found is that all these companies which become great over a period of time, they demonstrate a pattern, and that pattern is called flywheel effect. So what the flywheel effect is, it's basically a mechanical science concept. And in the olden times, we used to have those diesel generators which were used for power backup. And the way the mechanism works is that in the first stage, the operator of the machine has to rotate the lever which is attached to the machine. And then in the second stage, the machine reaches an inflection point. And at that point, as an operator of the machine, you have to pull the lever out. And then in the third stage, the machine starts generating the electricity. So basically, the same three stages are kind of followed in this transition, which is good to great. The first stage, the build-up stage, could take n number of years before the inflection points get hit. By n number of years, for some companies it could be few years, like 3-5 years, or for some companies it could take even decades, like 10 years or 20 years, and then those companies hit the inflection point. And what we have also found in our experience is that inflection point also happens for various reasons. One is that because of the efforts of the management which they have been putting it for those n number of years, or sometimes because of some macro event which shifts in favor of the company and it provides tailwind to the business. So, but because of these two reasons, the companies hit the inflection point in their journey. And once they hit the inflection point, then they enter the third phase, which is where as I said, that maximum wealth is created. So this was the part about how do we select stocks. And now let's talk about how do we figure out whether the companies have hit the inflection point.
Before diving deep into understanding the inflection point of the businesses, I would like to highlight a couple of aspects of our philosophy. The first one is we follow GARP philosophy. It is basically stand for growth at reasonable price. On a practical aspect, we have been deploying this quarterly analytics for the last 55 quarters plus, which is nothing but the 14-year long history of Alpha Growth PMS. So what do we do in this quarterly analytics is that we split it into two parts. The first, we call it a elimination stage analysis, and the second part we call it as a selection stage analysis. At the start of the elimination stage analysis, we take the top 800, 1000 odd companies listed, we put them in the descending order of their growth. When I am saying growth, to start with, I am talking about growth in the latest quarter, which was just gone by. And what kind of growth are we talking about here? We are talking about companies which are growing faster than 25-30% in the sales and the profitability as well. And we are talking about year-on-year growth, the latest quarterly earnings versus the previous year's similar quarter. Now, when we put the benchmark as high as 25-30% plus kind of requirement, most of those companies get eliminated, and we are left with only 100 or maybe 150 companies which would have grown at that pace or more. But as you would know, that one quarter growth can be a flash in the pan kind of a thing, and it can happen for n number of reasons, which could be purely because of low base effect or because of some of the aspects which play in the businesses where the revenues get spilled over from previous quarter to this quarter. So we basically want to do away with this kind of a anomaly. So what do? We take this 100, 150 companies, we try and see how have they grown in the earlier 2 or 3 quarters. Have they grown at the same pace in the earlier 2 or 3 quarters as well or not? Now, when we spread this filter from just 1 quarter growth to 3 or 4 quarters, most of these companies also get eliminated. And we are typically left with only 15, 20 or maybe 25 odd companies which are depicting consecutive 3 or 4 quarters of growth in excess of 25% in sales and profitability as well. Now that is a last stage of the elimination stage, but it's a very, very important one. The reason being, as I mentioned, that we are doing this exercise after every quarterly earnings season. And these were the companies which were, let's say, not coming on our previous quarter analysis, but now they are coming on our radar. What does that mean? That means that these 20 odd companies could potentially be hitting the inflection point in the good to great framework as far as the flywheel journey of those businesses are concerned. And that is the reason these 20, 25 odd companies, we will take it into the selection stage analysis. Now, what is selection stage analysis? It is basically the complete fundamental research on these companies. So, the key thing which we do here is we will meet the management, we will do the plant visits, we will try and understand what is the target addressable market of this product, the kind of business the company is operating in, what is the value chain of those businesses, who are the competitors of this company, are those competitors doing better than this company itself, and basically what we are trying to understand is what happens in markets that if you buy a growth company or a good business, but if you overpay for these good businesses, then it may remain a good business, but it may not be a good stock from a shareholder perspective. And hence, we are very, very cognizant of the valuations which we pay for these kind of stocks. So, typically the way we define reasonable prices, we would want to see the PE, the price to earnings ratio of these companies to be less than the growth in the earnings of these companies. So, when I am saying that these companies should be growing in excess of 25-30%, the PE should be less than the growth. So, the PE should be 20 times, 15x, 10x. The lesser it is, the better it is. The reason being, then that gives us the margin of safety while entering into these stocks. And once you have the PEG ratio, which is less than 1, where the PE is less than growth while buying into the stocks, there are two levers for the stock to move up. The first one is that the earnings itself can take the stock up. And the second one is that the PE re-rating which can happen in these stocks, where the stock can go up because of the PE re-rating also, as the institutions also get interested in these kind of businesses. So, that was on how do we identify a stock, how do we identify an inflection point, and how do we deploy the reasonable price metric. So, this brings us to the lesser discussed aspects of fund management, and portfolio construction is one of them. So, as far as Alpha Growth PMS is concerned, we have always been following this long tail approach as a very, very important risk mechanism, especially while managing into small and mid cap space of the investment universe. The reason why we do it is you have to understand the way it is different from the conventional way the PMSs are run is, despite being a PMS, we don't fall in the category of buying only 15 or 20 stocks in one portfolio. In fact, we have a long tail approach which I mentioned is a risk mechanism. Basically, we buy 35 to 40 stocks in one portfolio, and there is a very, very important reason for doing so. So, one needs to understand when we are buying, let's say 40 odd stocks in one portfolio, the way it is split is that the top 20 stocks in the portfolio will contribute almost 70-75% of the capital. The bottom 20 stocks will contribute to the balance 25-30% of the capital. Now, one needs to understand why is it so? Why do we manage the portfolio in this manner? When we are analyzing those 20-25 odd companies and boiling down to only 2 or 3 new names in a portfolio at the end of selection stage, you need to understand how do these stocks make an entry in our portfolio. So the starting allocation which we take in these new names after every quarterly analysis is a small one. We buy it at a 1% allocation to start with. So what basically happens is that they form the tail portion at 1% allocation in our portfolio. Once we buy them at 1% allocation and they form the tail portion of the portfolio, two things can happen. Either the earnings growth on the quarterly aspect can continue or it may not continue. And one needs to understand both the aspects. Stock can go down by 20%, 30% on such kind of disappointments. And that is where the risk mechanism kicks in. Because we buy it at 1% and if the stock has to fall by 20 or 30%, the impact of that stock on the performance of the portfolio is restricted to only 0.2 or 0.3%. And trust me, from a fund management team level, it is much more easier for us to cut the allocation at a 0.9, 0.7 or 0.8% kind of a allocation rather than buying it 5 and 8% and then going back on that kind of a allocation. So this again, as you would know, that we are inspired by few books, Good to Great being one of them. Another book which we are inspired by is called One Upon Wall Street, which is written by a famous fund manager, Peter Lynch himself. So he actually had spoken about this long tail approach in this book, and he had a very, very beautiful analogy to explain this very beautifully. He says that this is equivalent to having a beautiful garden. So the way he explained is that if you want a beautiful garden, the strategy needs to be very simple. You basically need to water the flowers and cut the weeds. And that is exactly what we are trying to do here. We are trying to scale up the allocation in stocks which are following up on the growth front and cutting the ones which are not following up on the growth front. And that is why the long tail approach is a very, very different and very, very important risk mechanism as far as Alpha Growth PMS is concerned.
So as I discussed in the beginning, the three important questions are how to pick a stock, how to construct a portfolio, and how and when sell the stock. Especially in a small and mid-cap strategy, ultimately two things will happen if you are investing in a high growth small cap company or mid cap company. The growth will never be forever. After a high growth phase of maybe 3 years, 5 years, 7 years, the growth will eventually taper down because of the size. And the second aspect which plays is the valuation. So while we said that in the beginning we buy companies with a PEG of less than 1, eventually as these companies grow and they become more popular, more and more other investors also become interested in those companies, and eventually they become expensive from a PE perspective. So from these two aspects perspective, we need to exit those companies. What we explained is that our entry strategy was to buy high growth companies at relatively low valuation, which means having a PEG of less than 1. So our exit strategy is basically simple, but to explain, it is exactly inverse of our entry strategy. At the time of exiting, we look at either the growth tapering down or the PE starts going up. So as I said, that it is very important to have an exit strategy in the style, and especially for mid and small cap companies.